Well, maybe what I do first is just give you a 1-minute overview of Jones Lang LaSalle, since we haven't spoken here before. The real estate investment banking group within Jones Lang LaSalle has 3 primary purposes. One is we basically find money for people. So we raise equity and we raise debt on a one-off basis. We're also working across the country with all of our investment sale professionals and assisting them in trying to push value on the assets that they're selling. The second line of business is we're equity fundraising. We're actually doing our first one right now. It's a new line of business for us. We're doing a $300 million equity raise through a broker-dealer. And the third leg of the business is note sales. We're doing note sales on a whole loan basis, and we're also doing something we hadn't done before. We started about 6 months ago, and we're selling notes online. It's a business that hasn't been done. It's been done on the single-family side, but it has not been done on the commercial side, and so we've sold about $1 billion year to date. It's like eBay. It's like buying stuff on eBay, but you're buying office buildings and shopping centers, no land, and on a one-off basis, and you won't know any of the buyers. So it's really interesting, but the industry is changing, I think, for all of us. What I want to talk about first is just kind of an overview of maybe 6 things that have been affected by the recession in the real estate world. The first comment is it's all about the banks, and that's what we've been saying the last several years. It's all about the banks. They've got $1.7 trillion outstanding debt, half the outstanding debt. And so when you take a look at where the money, where the lenders are, it's the banks, and then it's everybody else. And the CMBS lenders is 20%, so that's the second big chunk of money. And for the last several years, they've been completely gone. They're obviously making a little comeback now, but they're not going to be anywhere near where they were before. And then you go back down to the life companies and then the agencies. Outside of that, really nobody else, is significant. So the agencies are having their own problems with Freddie Mac and Fannie Mae. The life companies are still there. They haven't grown in 40 years. They're going to put $40 billion out 30 years ago. They're going to put $40 billion out 20 years ago. They're going to put $40 billion out this year, every single year. So don't count on the life companies stepping up and taking market share from anybody. They just are not going to do that. And so when we're thinking about maturing debt and who is going to be refinancing this $3.4 trillion of debt that's going to be maturing over the next couple of years, it's about the banks. So when the banks start, lending more money, as opposed to, right now they're lending a lot of money. It's, Bill, your loan's coming due. I'm going to lend you money again for that same project, same terms or different terms. That's the money that's being lent. They're not lending. It'd be interesting to see what you have to say, but they're not lending out a bunch of new money to Jim over here that wants to build a new project. That's not where the money is. It's all being lent to existing clients on existing assets to kind of push it down the road a little bit. The second major event is the significant gap between the bid and the ask. Much better today than it was several months ago, and it also depends on what market we're talking about. And so if you're talking about Washington, D.C., New York, San Francisco, L.A., those markets are much, much better than anywhere else. Now, Houston's doing well and would be in the second tier together with maybe Boston and Seattle. So there's not as significant of a gap between the ask and the bid. But if you go the rest of the world in the the rest of the United States, there is a significant gap because, especially on the product that's not core product, not the best markets, not the best product. The third thing is transaction volume's down 80%. It's probably 90% last year. It's probably down a total of 80% from the peak this year. So there's a lot of properties that are out there that want to be sold, want to be refinanced. A lot of it just can't, and that's why, in large part, that number is down so much. The fourth point is the defaults and delinquencies continue to increase. I think that we'll show that it's going to continue to increase over time. There's been all this money out here trying to take advantage of these foreclosures that haven't occurred. We can talk a little bit about that too. there's these distressed situations, especially on large loans. We're seeing the restructures. The stuff that is being foreclosed on or notes being sold tend to be with owners that are no longer really clients of the banks or the special servicers, or real problematic, small. The big stuff, we're seeing, unless you just got a bad sponsor, everything's getting worked out okay. And then I talked about note sales before. We're doing a lot of note sales. So let's take a look at the distressed properties. And so we have three components. We have troubled loans, we have REO, and we have restructured. So troubled is, we have a problem. Everyone knows we have a problem. We just, really haven't fully recognized it. There's a lot of loans been made, especially over the last, in 2005, 6, and 7, that were at the peaks, and the leverage levels were in excess of 100% of what is today's value. Interest rates are low enough, so you still have, maybe performing loans. You just, no one's going to refinance them out. You got trouble. You have, you do have some REO, not a lot, and not a lot of good product. And then thirdly, you have you have restructured debt. That restructured debt tends to be short-term fixes, a little Band-Aid, maybe a 6-month extension, maybe a year extension. It doesn't really do anybody any good other than prolong that issue.